Let's jump right into this explainer. Today, we're unpacking something that sounds way more intimidating than it actually is: cash-secured puts. We'll be pulling directly from the incredibly pragmatic insights of Apen Quotes, a fantastic financial blog out of Singapore. We're going to break down their structured approach to options trading, everything from the core mechanics and real-world win rates to the absolute non-negotiables of risk mitigation. I want to start with a quote from the late Charlie Munger that really hits the nail on the head. He said, "It takes character to sit with all that cash and to do nothing." You know the feeling, right? Sitting on cash just feels wrong, like you should be doing something. But that idea is the whole philosophical foundation for today's topic. Selling cash-secured puts is basically the art of getting paid just to wait. It's a super methodical way to generate regular premium income while you patiently hold out for a better price on a stock you already want to buy. So, here's our roadmap for this explainer. 1. The core mechanics. 2. The trade life cycle. 3. Win rates and reality. And 4. Strict risk mitigation. All right, section 1, the core mechanics. Let's establish exactly what setting up a cash-secured put actually looks like in practice. Think about the traditional way we buy stock. You pick a company, pay the current market price, and boom, you own it. Simple. But when you sell a cash-secured put, you're flipping the script. You aren't buying the stock right away. Instead, you're acting kind of like an insurance underwriter. Somebody actually pays you a cash premium today. And in exchange for that upfront cash, you agree to buy 100 shares of a high-quality stock at a specific agreed-upon price, the strike price, if the stock happens to drop below that level before the contract expires. To make it cash secured, you just keep enough cash sitting in your brokerage account to cover the purchase if you do get assigned those shares. So, long story short, you're selling an out-of-the-money put option and getting paid cold, hard cash to take on that obligation. Now, I just mentioned selling an out-of-the-money put, but Apen Quotes specifically focuses on low delta puts. In the auctions world, delta is a really common metric, and the blog rightly points out that it's a fantastic proxy for probability. When they say low delta, they're targeting a delta of 0.15 to 0.20. And what does that actually mean for us? It means the market is basically estimating a 15 to 20% chance that the stock will actually drop below your strike price by expiration. It's just a handy measure of probability based on how the market is currently pricing things. So let's flip that math around for a second. If there's a 15 to 20% chance the stock finishes below your strike, that leaves an 80 to 85% theoretical probability that the option you sold expires entirely worthless. And let me tell you, as an option seller, an option expiring worthless is exactly what you want. It means the insurance contract you wrote wasn't needed, the buyer doesn't exercise it, and you walk away keeping that entire premium you collected on day one as pure 100% profit. Plus, all that cash collateral you were holding gets instantly unlocked. Section 2, the trade life cycle. Let's talk about what actually happens after you click sell. Once your put is sold, the trade can really only take one of three paths. Step 1 is that ideal scenario we just covered. The stock stays above your strike, the option expires worthless, and you keep all the premium. Step 2 is assignment. This kicks in if the stock drops below your strike price. At this point, you are legally obligated to buy those 100 shares. But hey, your actual break-even point is lower than the strike price because you get to subtract the premium you've already pocketed. You're essentially buying a stock at a discount to what it was trading at when you opened the trade. Then there's step 3, the early close, and the blog strongly recommends this. You don't actually have to hold these contracts all the way to expiration. If the stock suddenly rallies or if time decay just erodes the option's value, you can buy that put back for a fraction of what you sold it for. Boom, you lock in a quick profit, take the risk completely off the table, and free up your capital for the next trade. Moving on to section 3, win rates and reality. Let's step away from the pure theory for a minute. We have to ask a really critical question here. Does a high win rate actually equal a high total return? I mean, on paper, an 85% win rate sounds like a license to print money, doesn't it? It sounds completely foolproof. But as we all know, the hard truth of the financial markets is that things are rarely ever that simple. The real issue boils down to one thing: asymmetric risk. Yes, you are going to win the vast majority of your trades. You'll consistently collect these nice, small, frequent chunks of premium. But the danger lurking in the background is the large, infrequent loss. If you sell a put on a stock, and that company suffers a massive structural drop, say a huge scandal or a totally broken business model, you are still on the hook to buy those shares at your much higher strike price. And let me be clear, one single major loss on a bad stock can literally wipe out months, if not an entire year, of all those little premium gains. Still, there's a very good reason this strategy remains an absolute favorite among institutional traders, and it comes down to the difference between implied and realized volatility. Implied volatility is essentially the market's fear premium. It's the price buyers are willing to pay for insurance because they're terrified of what might happen tomorrow. Realized volatility, though, is how much the stock actually ends up moving in reality. Append Quotes points out a fascinating statistical edge here. Options are systematically just a little bit overpriced because the market's fear is almost always higher than the actual realized movement. Because of that built-in fear premium, your actual win rate on a 0.15 delta put, if you look at a large enough sample size, often pushes closer to 88 or even 90%. You're literally getting paid for taking the other side of the market's irrational fear. Which brings us right into our fourth and undeniably most important section, strict risk mitigation. The real secret to long-term success with this isn't just hunting for the highest possible premium. No, it is all about rigorous, unemotional risk management. First up, the absolute golden rule. Never, ever sell a put on a stock you wouldn't be completely comfortable holding for the long haul. You want to seek out high-quality businesses with deep economic moats and avoid those speculative meme stocks like the plague. If you do get assigned, you want to actually be happy that you just bought an amazing business at a discount. Next, you've got to manage your time. The blog identifies 30 to 45 days to expiration as the absolute sweet spot. This is exactly when theta decay, which is just the option naturally losing its time value, really starts to accelerate. You want that decay working in your favor. And finally, avoid earnings weeks. Seriously, selling a put right before a company drops its earnings report is basically just gambling with massive volatility spikes. So all of this leaves us with one vital question you really need to ask yourself. Are you selling options on stocks you actually want to own? Because if the answer is no, you're just chasing yield and you are absolutely playing with fire. But if the answer is yes, then selling cash-secured puts can be a truly brilliant way to get paid while you wait for your price. I highly encourage you to go read the full post on the Append Quotes blog for a much deeper dive into their pragmatic approach to portfolio management. Thanks so much for hanging out with me on this explainer. Keep learning, stay disciplined out there, and I'll catch you next time as we break down another fascinating topic.